Brent crude just hit $91.62 and WTI hit $85.83. 3 days straight of gains. But here's what the mainstream isn't telling you. EIA just reported a massive 4.4 million barrel inventory build. That should have crushed prices. Instead, oil rallied. Why? Because the Strait of Hormuz is effectively a war zone right now, and supply risk is overriding everything else. I've got 3 trades lined up, 2 scalps and 1 swing, with exact entries and stops. Watch the full breakdown on Trade Meridian Decoded. Let me paint you a picture of what's happening in the oil market right now. It's August 20th, 2026, and Brent crude has just settled at $91.62 a barrel, up 60 cents. That's a 0.66% gain. WTI crude is trading at $85.83, up 89 cents, a 1.05% move. 3 consecutive days of gains. And the mainstream financial media will tell you it's about supply and demand, about inventories, about OPEC plus production targets. But if you're trading oil this week and you're not watching the Strait of Hormuz, you're trading blind. Here's what's really moving this market. Iran's parliament is actively considering legislation that would ban American and Israeli vessels from passing through the Strait of Hormuz. The 60-day ceasefire period between the US and Iran has expired with zero progress on a lasting peace deal. And just last week, vessels operated by Abu Dhabi National Oil Company were attacked in the strait. This is not theoretical risk. This is supply disruption in real time, at the choke point, through which roughly 20% of the world's seaborne oil passes. Now, I've been trading through geopolitical crises for 2 decades, and I can tell you this, the market is not pricing this correctly. The premium we are seeing is still too contained, too complacent. And that creates opportunity. I'm the founder of Alpha Market Meridian, and in this video I'm going to walk you through exactly what I'm seeing across the charts, why the fundamentals are sending mixed signals, and the 3 trades I'm looking at for the next 24 to 72 hours. Let's get into it.my bias going into this week is cautiously bullish on oil, but with a very specific caveat. We are approaching a critical resistance zone that could trigger a sharp reversal if it holds. For Brent, the key level I'm watching is $92.17. That's the R1 pivot based on today's classic pivot calculation. Above that, we are looking at $92.78 as the next major hurdle, and then $93.19. For WTI, the pivot sits at $85.29, with a 1 at $85.67 and a 2 at $86.21. Here's my bottom line. Oil wants to go higher on geopolitical risk, but the technicals are flashing warning signs that we are entering overextended territory. The invalidation level for my bullish bias is a daily close below $90.13 on Brent. That's the S3 pivot, or below $83.83 on WTI. If we break those levels, the geopolitical premium is evaporating faster than anyone expects. Let's start with the weekly chart, because this is where the big picture narrative lives. Brent crude has been in a broad range between roughly $88 and $96 since late July. We saw a spike above $96 at the end of July, then a pullback toward $88, and now we are rallying back toward the upper end of that range. This is classic consolidation within an uptrend. The question is whether we have enough momentum to break out or whether we are about to get rejected from resistance yet again. What stands out to me on the weekly is the moving average structure. The 50-week moving average is sitting well below current price, around the mid-ADS, which tells me the long-term trend is still firmly intact. But we are also seeing some divergence between price and momentum that I don't love. Now, moving down to the daily chart, this is where things get really interesting. Brent is currently trading around $91.50, and the daily moving averages are sending a mixed signal. The MA5 is at $92.01 and is showing a sell signal. That tells me short-term momentum is fading even as price moves higher. The MA10 is at $91.77, also a sell. The MA20 is at $91.74, sell. But then you look at the MA50 at $91.26, that's a buy signal. The MA100 at $89.60, buy. and the MA200 at $88.11. BU wide SO. What's this telling me? It's telling me that the longer-term trend is still bullish, but short-term momentum is rolling over. This is exactly the kind of divergence I've seen play out before, and the tell is always in the volume and the reaction at key levels. Let me share a personal observation here. I've seen this exact pattern 3 times in my career, where price is grinding higher but the shorter-term moving averages start flipping to sell signals. Twice it led to a violent reversal within 48 hours. Once it didn't, and that was when a major geopolitical event intervened and blew through the resistance. This feels like one of those moments where the market is waiting for a catalyst, and the catalyst is either going to be a breakthrough above $92.17 or a breakdown below $90.13. The RSI on Brent is sitting at 48.726 on the daily. That's neutral. Not overbought, not oversold. The MACD is at 0.180 and showing a buy signal, but it's weak. The ADX is at 22.160, neutral, indicating we are not in a strong trend. The CCI is at minus 61.0952, which is a sell signal. And the ATR is at 0.68, indicating above average volatility. Now look at WTI on the daily. This is where the divergence between the two contracts becomes really telling. WTI's daily summary is showing strong buy. The MA5 is at $85.17, sell signal. The MA10 is at $84.90, buy. MA20 at $84.82, buy. MA50 at $84.36, buy. MA100 at $83, buy. MA200 at $82.14, buy. So WTI is showing much stronger bullish alignment on the moving averages than Brent. The RSI on WTI is 54.836, neutral. MACD is 0.240 with a buy signal. ADX is 19.601, neutral. CCI is 61.3467, buy. And here's the kicker. 8 technical indicators are showing buy signals on WTI, 0 are showing sell. That's a powerful bullish consensus on the daily timeframe. Now let's drop down to the 4-hour chart. This is where I'm seeing the most actionable information for short-term trades. On Brent, the 4-hour momentum is starting to roll over from overbought conditions. We are seeing increasing selling pressure on rallies toward the resistance levels. On WTI, the 4-hour RSI has been flirting with overbought territory and is now pulling back. The volume profile is showing that sellers are stepping in on every attempt to break higher. And finally, the 1-hour chart. This is my scalping timeframe. Both contracts are showing consolidation patterns near their respective resistance levels, which tells me the market is coiling for a move. The direction of that move will be determined by the next headline out of the Middle East. Alright, let's talk about what's actually driving this market, because the technicals alone don't tell the full story. And I want to put the news and calendar front and center because that's where the real price action is coming from. The single most important fundamental driver right now is the Strait of Hormuz. Let me give you the facts. The Strait is seeing significantly reduced traffic, with shipping data showing that 2 major Chinese shipping companies have halted oil tanker transits through the Strait. Saudi Arabia's oil exports remain constrained. They've been forced to reroute via the Suez Canal, going around Africa, which adds substantial time and cost to deliveries. Meanwhile, Gulf states are resorting to shipping oil covertly on tankers with transponders switched off to avoid detection. Now, here's the fundamental disconnect that every oil trader needs to understand. On one hand, we have the EIA reporting that U.S. crude inventories rose by 4.4 million barrels in the week ending August 14th, bringing commercial stockpiles to 428.8 million barrels. That's the third consecutive weekly build, and it came in well above expectations of a 600,000 barrel draw. Gasoline stocks also rose by 700,000 barrels. On the other hand, the International Energy Agency is reporting that observed global stocks fell by 69 million barrels in July, and total observed stocks are down roughly 410 million barrels since the conflict began. So we have US inventories building while global inventories are drawing down. And the market is choosing to price the global story, not the US story. What stands out to me is not the headline inventory number, it's the reaction. Normally, a 4.4 million barrel build against expectations of a draw would send oil down 2% or 3%. Instead, prices rose anyway. That tells you everything you need to know about what the market is focused on. Supply risk around the Strait of Hormuz is overriding conventional fundamentals, and it's doing so decisively. Now let's look at the calendar for the next 3 to 5 days, because this is where the real volatility catalysts are. First, we have ongoing negotiations, or lack thereof, between the US and Iran. The 60-day ceasefire period has ended with no progress. The Iranian parliament is actively considering legislation to ban American and Israeli vessels from the strait. Any headline that suggests escalation will send oil higher. Any headline that suggests de-escalation will send it lower. Second, we have the OPEC Plus dynamic. 7 OPEC Plus members, Saudi Arabia, Russia, Iraq, Kuwait, Kazakhstan, Algeria, and Oman, have agreed to increase production by 188,000 barrels per day for September. This is a relatively modest increase, and it was already priced in when it was announced on August 2nd. But watch for any commentary from OPEC Plus officials about potential adjustments if the Strait situation worsens. Third, we have the U.S. administration's policy shift. Treasury Secretary Scott Bessent signaled that Washington would soon announce economic measures directed at Iran. This represents a shift away from military action toward economic pressure. In the short term, this could actually support oil prices if the measures are seen as ineffective, because it suggests military escalation is off the table. But in the medium term, if economic pressure succeeds in bringing Iran to the table, it could erode the geopolitical premium. Fourth, and this is the one I'm watching most closely, the EIA's August short-term energy outlook raised its 2026 WTI average forecast to $80.88 from $76.26, assuming Hormuz constraints persist through August. The IEA forecasts global demand to fall 1.6 million barrels per day in 2026, a larger contraction than previously estimated. So we have demand destruction on one side and supply disruption on the other. The market is currently pricing the supply story, but that could flip quickly if demand concerns resurface. Now let's get to what you came here for, the actual trade setups. I'm going to give you 2 scalps and 1 swing trade with exact levels, triggers, and risk-reward ratios. Trade setup 1. Brent scalp. This is a short-term scalp on Brent crude, looking to catch a rejection from resistance. Entry trigger. Price touches $92.17, that's the R1 pivot, with a bearish rejection candle on the 15-minute or 1-hour time frame. I want to see a wick that's at least twice the length of the body, indicating strong selling pressure at that level. Stop loss, $92.50, just above the R1 pivot and the recent swing high. This gives the trade room to breathe while keeping risk contained. Take profit 1, $91.15, that's the S1 pivot level. This is my first target, and I'm taking half off here. Take profit 2, $90.74, the S2 pivot. This is my second target, and I'm letting the remaining position run to this level. Risk reward, approximately 1 minute and 2.3 seconds from entry to TP1, and 1:4 from entry to TP2. Invalidation. A daily close above $92.78 invalidates the bearish thesis and suggests we are breaking out to the upside. Trade setup 2. WTI scalp. This is a momentum scalp on WTI, looking to catch a continuation of the bullish move. Entry trigger. Price breaks and holds above $85.67. That's the R1 pivot for WTI, on strong volume. I want to see the 1-hour candle close above this level with increasing volume. Stop loss, $85, just below the pivot at $85.29. This gives the trade room to breathe while keeping risk manageable. Take profit 1, $86.21, the R2 pivot. Taking half off here. Take profit 2, $86.59, the R3 pivot. Letting the rest run to this level. Risk reward, approximately 1 minute and 1.7 seconds to TP1, and 1 minute and 2.9 seconds to TP2. Invalidation. a break back below $84.75, the S1 pivot, invalidates the bullish setup and suggests a false breakout. Trade setup 3. Swing trade oil spread. This is the trade I'm most excited about, and it's not a directional bet on either contract individually. It's a trade on the spread between Brent and WTI. Here's my thinking. Brent is more exposed to geopolitical risk in the Middle East because it's the global benchmark that prices Middle Eastern crude. WTI is more exposed to U.S. inventory dynamics and domestic demand. Right now, the spread between Brent and WTI is around $5.80. Brent at $91.62 minus WTI at $85.83. I expect this spread to widen further if geopolitical tensions escalate, because Brent will outperform WTI on supply disruption fears. I expect it to narrow if tensions ease, because WTI will catch up as the risk premium fades. Entry: long the Brent WTI spread, meaning I'm buying Brent and selling WTI in a ratio that's dollar neutral. I'm entering at current spread levels around $5.80. Stop loss: a spread contraction to $5.20. This represents a significant narrowing that would indicate the market is pricing out. Geopolitical risk. Take profit 1, $6.50. This is my first target, representing about a 70-cent widening. Take profit 2, $7.20. This is my second target, representing a full $1.40 widening from entry. Risk reward: approximately 1 minute and 1.5 seconds to TP1, and 1:3 to TP2. Invalidation: a sustained spread below $5 would invalidate the thesis and suggest the geopolitical premium is fully priced out. Now, here's a personal insight I want to share. I've traded oil spreads through multiple Middle East crises over my career, and what I've learned is that the spread is often a cleaner trade than a directional bet. When I was trading through the 2022 energy crisis, the spread trades outperformed my directional positions by a significant margin. The reason is simple. When you trade the spread, you're hedging out the broader market moves and focusing purely on the relative value. And in a market driven by geopolitical headlines, relative value is often where the real edge is. Let me take 30 seconds to talk about risk management, because this is where most traders get it wrong. Every single one of these setups has a defined stop loss for a reason. The market can stay irrational longer than you can stay solvent, and geopolitical headlines can flip in an instant. Here's my personal rule. I never risk more than 2% of my trading capital on any single oil trade, and I scale my position size so that my stop loss represents that 2% risk. If I'm trading the spread, I might go up to 3% because the spread is generally less volatile than the outrights, but I'm still disciplined about it. I remember a trade back in August 2022. Similar setup, similar geopolitical backdrop. I was convinced oil was going to break out. I got the direction right, but I got my position size wrong. I was overleveraged, and when the market whipsawed on a headline, I got stopped out at the exact bottom before the rally continued. I learned that lesson the hard way. Now I always size my position so that even if I get stopped out 5 times in a row, I still have 90% of my capital intact to fight another day. Trading oil in a geopolitical environment is not about being right, it's about being right with the right risk management. The headlines will move this market violently, and if you're not positioned with appropriate stops, you will get run over. So let me summarize what I'm watching for the rest of this week. The key level for Brent is $92.17, that's the line in the sand. If we break above it with conviction, we are looking at a move toward $92.78 and potentially $93.19. If we reject it, we are looking at a pullback toward $91.15 and $90.74. For WTI, it's all about $85.67. Above that, we target $86.21 and $86.59. Below that, we are looking at $84.75 and $84.37. The geopolitical calendar is the real driver. Watch for any headlines out of Iran, any statements from the U.S. administration, any updates on the Strait of Hormuz. Those headlines will move the market faster than any technical indicator. I'll be back on Friday with my weekly recap, breaking down how this played out and what I'm watching for the week ahead. And on Sunday, I'll have my full preview of the upcoming week's calendar and key levels. If you found this analysis valuable, hit that subscribe button and turn on notifications. I post 3 deep dive market breakdowns every week, and I don't want you to miss the next one. And don't forget to drop your levels in the comments below. What's your read on oil this week? Are you bullish or bearish? Let me know. This is Trade Meridian Decoded, Trade Smart, Trade Disciplined, and I'll see you in the next one.